Hey everybody, my name is Abby. Welcome back to the channel. Welcome if you're new. Today I'm going to be doing a long-awaited video. I've talked about doing this for a long time. Finally sat down and wrote it out. So here it is, my about credit video. So yeah, most of my videos that I do, I'm holding up my script, so I'm like fanning myself with it, but most of the videos that I do on here are about like makeup and stuff, and I'm also doing a series about paying off debt. I'm also on a no-buy this year. It's trying to pay off debt, save money, and not accumulate so much stuff. So I thought I would talk about credit because I have a unique perspective, so I'll get into that. The credit is a very complex system, and in this video I'm focusing on credit in the United States, so I know nothing about how credit works in other countries, so don't assume that my advice will be accurate in your country, because I don't know. Also a disclaimer, I am not a licensed credit professional or a credit expert. I did, however, work for a few years at one of the biggest, if not the biggest bank in the US and possibly the world as a credit underwriter. I dealt with credit card applications, and basically I would approve, or I would review dozens, sometimes hundreds of credit reports per day and determine if people would be approved and for how much. Also, my work was focused on people who had a fair amount of money. So as a user of credit myself, I know a little bit about how credit works in both the lending and the borrowing aspect. So let's get started. How do you get credit in the first place? There are a few ways in which you can start building credit, just don't expect it to happen overnight. The only people who I've ever seen who have perfect credit scores are people in their 50s and 60s, and I've seen some 20s and 30s that were close, but the age of your accounts does factor into it, and I'll talk about that in a little bit later. The first way that you can start building credit is the one that I personally used, was having a student loan. Obviously, you shouldn't go to college or something like that just to get credit, but it's how a lot of people get started. You can be approved for a student loan without any prior credit history. And while you're in school, your loan will be in deferment until you graduate, which means that you won't have to make any payments until it's a certain time after you graduate. I can't remember if it's 6 months or a year, but you don't have to make payments right away. But I would very strongly suggest to make payments before you graduate if you're able to, if you can afford it, because while your loan doesn't accrue interest while you're in school, at least some do. Some might not. I'm not sure how that works, but mine didn't. So when your loan doesn't accrue interest while you're enrolled, so any payments that you make will go toward your principal amount and therefore will reduce the amount that you pay in interest over time after you graduate. Then once you make payments on your loan regularly and on time, which is extremely important, then the bank may consider you for a credit card, which leads me to the second way to build your credit. So I also took this route in addition to my student loan, and that's what's called a secured credit card. A secured credit card is a card usually with a low limit, maybe $500 or less. However, you have to keep that amount locked up in a savings account, or at least a portion of that amount. And it depends on the bank or the credit union that you go through, like their rules on it. So this helps you build trust with the bank, because if you default, or that basically a fancy way of saying you don't pay the bill, then they will still get their money back and you'll just get a ding on your credit, but the bank won't be out any money. So once you make regular on-time payments, then it will help build your credit, and the bank may consider you for a normal unsecured credit card later on. And secured cards may also require a cosigner, again depending on your bank. I would check with the bank that you have your checking account with, because they would be your best bet on getting a card, but not all banks offer them. That's just a good place to start. So once you have made payments on time on the secured card, I would suggest to wait no less than a year before you try for a new unsecured card. Then if you do get your hands on an unsecured card, don't close your secured one right away, as tempting as it will be to free up that money that's in your savings account. Like I mentioned before, part of your credit score is how long your accounts have been open. So if you close your first one right away after you get a new one, then you're essentially starting over, because it doesn't count your closed accounts, it only counts the ones that you have open. So it's better to have one that's been open for a long time and then a bunch of new ones. And a good practice on your first card, and really any card after that, is to use it for small purchases that you can pay off with your next paycheck or within that month billing cycle. So a lot of people will buy gas with it and pay it off right away. This ensures that you won't get in over your head and spending it on a bunch of other stuff, and also protects you from those gas station credit card skimmers, because you're not liable for unauthorized purchases, and it'll be the bank's money that they steal instead of yours. And you can also use it for something like Netflix or Hulu and set it to auto pay, so you know it'll be paid every month. And it's not, Netflix or Hulu is not going to break you, every month like something more expensive. So you might be asking, why do I need to use the cards? Can't I just get them and cut them up and not use them? That would be more responsible, I would think, right? Well, yes and no. You want to charge at least something to the card because that will show that you have a good payment history. Banks can see your payment history when they pull your credit report. So if you're not using a card, it will show up inactive, so the lender that's looking at your credit report won't be able to determine if you always pay on time because there's nothing for you to have paid. And also, the bank that issued the card can and will close your account if you're inactive for a certain period of time, usually about 2 years. They'll do that in case you have lost the card or something and forgot about it so someone else doesn't try to use it. And also, banks actually have a finite amount of money that they can lend, so they'd rather lend it to someone who's going to use it, otherwise they're not making money. However, this does not negatively affect your report. It will just say that it's closed for inactivity. But if you do something like charge it up and not pay it and the bank closes it, then yeah, it's going to look bad. Sometimes if it's closed for inactivity, your bank may or may not reopen it for you if you ask them, but not always. So the worst thing that they could do is say you need to reapply. So now if you're like me, when I first got started with credit, first started that job, I was like, wait a minute, why does the bank want you to pay in full versus over time? Surely they don't make any money that way because you're not paying interest, right? Very wrong. Every time you swipe your card or type it in online, both with debit and credit cards, merchants have to pay a fee to be able to process your card. So they're making money. And plus, if you pay in full and on time, they're not sitting around and waiting for the money to be paid back. And there is one last way to start building credit that I don't recommend, but it has worked for very few people. If you know someone that you trust and that trusts you, you can ask them to be added to one of their credit cards as an authorized user. To the bank, this means that you can use the card and nothing else, but it does report to your credit. So this is why you want it to be a trustworthy person, because if they don't pay, then it also looks bad on you. But the problem with this is that most banks, not all of them, but most, will not consider these accounts to be too legitimate when they're looking at your credit report, because they're not really worth as much to you as your own account because you're not responsible for paying. So they're not a good reflection of you and how you're paying your bills. They're a reflection of the other person, how they're paying their bills. Sometimes banks can overlook this or it will sneak past their system, and so it's a crapshoot on whether or not this is going to work. Now let's talk about responsible use of a credit card. What lenders are looking for when they review your individual credit accounts on your credit report is that, number one, that you're paying on time every month. Number two, your credit limit. A high limit looks better than the low one. It means that other banks trust you. And three, your utilization. So utilization plays a very important role in how your credit looks. It's almost as important as how you're paying your payments on time. And ideally, you want your utilization to be less than 30%. So for example, if your credit limit is $1,000, you want to be using less than $300 because 300 is 30% of 1,000. Also keep in mind, this is something that a lot of people may not know about credit reports, is that lenders can also see the upper cap of how much that you've charged in the past. So they'll know if you've had it charged up to the limit or not. But ideally, if you're being completely financially responsible, never charge more than you can afford to repay in full each month. It's not a make or break deal if you've charged a lot on the card. They understand that stuff happens. It's just in your best interest to not get that ball rolling, believe me. And let's talk about other factors that go into your credit. If you've got a card and have used it wisely, that's good, but not exactly enough. And lenders will look at your credit inquiries as well. What's an inquiry, you say? Every time you apply for credit, even if you apply for a higher limit on your existing card, the lender will pull your credit report, and it keeps a log of every time that someone checks it. So there are such things as hard and soft inquiries. Sometimes, even if you're opening a new phone line or getting utilities set up at a new house, they'll pull your credit. Basically, anytime you're providing your social security number for something, assume that your credit report is going to be pulled. Things like credit cards and loans will almost always do a hard pull, meaning that it will appear as an inquiry on your report, and the lender gets all the details, everything pretty much about your credit. And occasionally other things will come up as a soft pull, meaning that it does not report as an inquiry, but the lender doesn't get as much detailed information. So to be on the safe side, just assume that every inquiry is going to be a hard inquiry and you won't have any surprises. So inquiries are not bad, however, except when they are excessive or very close together, like more than one in a day. Usually 2 on your report is fine and dandy for most lenders, but any more than that and not so much. There are a lot of reasons for this, and I told you the video would be long. So I've heard people describe credit like this. To get credit, you have to prove that you don't need credit. And excessive inquiries can make you look like you're desperate for a new account, as if you need money and you don't have it. So this, coupled with high utilization on other cards, is a red flag. And also a big part of my job at the bank was preventing fraud. So say if you're somebody who doesn't use credit a lot, haven't opened new accounts in a really long time, and then we get an application with your information and we scroll down and see that you have 5 to 10 inquiries in the past few days, that looks a lot like fraud. Identity thieves will apply as fast as possible to as many places as they can to avoid getting caught. And the computer is pretty good at catching stuff like this these days, so you'll probably find out before that happens. Also, something to watch out for in regards to inquiries. A lot of people might be caught off guard by this if you haven't experienced it before, is that auto dealers, mainly used car lots, will run your credit multiple times through different lenders without telling you. I've seen as many as 8 inquiries just from a used car in one day. So the good news is that the credit report will differentiate an auto loan inquiry from a credit card inquiry. So most banks, especially if it's a person looking at it, they'll know that, you're not committing fraud. You just applied for a car, because it'll say like auto or something next to it. I maybe wouldn't be shopping for a used car soon before you apply for a mortgage though, because they're more strict on your inquiries. But even the better news is that inquiries will fall off of your report after a period of time. There is not really an exact amount of time, but typically it's about 2 years. So, like I said, building credit is not fast whatsoever. It takes years for things. Now let's talk about something a little more fun, debt to income ratios. As if all of that wasn't enough and your head isn't already spinning, let's add another factor. Your debt to income ratio is the sum of your monthly debt payments compared to your monthly income. You want this to be as low as possible. It includes all of your credit cards, personal loans, auto loans, even your mortgage or rent payment. But it does not include other things like gas, utilities, food, etc. Generally speaking, 50% is getting pretty high. This means that half of your income is spent on paying debt and the rest you have for living expenses. For example, if you have a monthly income of $1,000, just to keep the math simple, and you pay $300 for your mortgage, $50 for a credit card, and $150 for your car loan each month, that's a total of $500, and $500 out of $1,000 is 50%, and you only have $500 for food, gas, and utilities. This makes you more likely to start relying on credit to survive, which is a huge red flag to lenders. However, there is a legal disclaimer that says you can count your spouse's income as well if you both share bills. So if you're like, wait, my debt to income ratio is really high, what's going on? That's probably why, if you share bills with a spouse or somebody you live with. So to boil down what lenders are looking for when they review your application, they want to see your ability to pay, which is income, your stability, which is that you're consistent with payments, not moving around a lot, keeping a job. That's why if you apply for things, they will ask you where you work and how long you've been there, or how long you've lived at your current address. And also your willingness to pay, which is that you're making payments on time and don't have any accounts and collections. These things will vary from bank to bank and even from different sectors in the same bank, like credit cards, loans, and mortgages. Also, something I'd like to throw in here is that lenders can see a lot more on your report than you probably realize. It shows all of your collections, including small ones, prior bankruptcies, any unpaid fines, tax liens, and any unpaid child support. And often, if you're calling a call center about your application, they may not have the liberty to tell you anything specific about your credit report. That was the most frustrating thing, was it's like there's one thing wrong with the person's application and I couldn't tell them. And all they can do is give you generic reasons as to why your application was denied or not approved for as much as you wanted. But you do have a right to dispute any incorrectly reported information with the credit bureaus directly, so Equifax, TransUnion, and Experian. It's a good practice to review your full report, not one of those monitoring websites, but your actual full report once a year. And you can get a free copy once a year. Just Google free credit report. I think it's freecreditreport.org or something. And make sure that it's the absolutely free one. If it asks you for your credit card information, it's not legit. Find the free one. And those monitoring sites are okay for checking your progress or catching things like fraud, but they're not a good substitute for the real report. They're just estimates. I'm not going to mention any names of any companies, but I think you know what I'm talking about. So The credit scores given on those sites can be off by as much as 100 points. I've seen somebody will call in and be like, you sent me a letter saying my report was blah 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 and my blank blank company said it was blah blah blah. And that's because they show each credit report individually, and it's a guess based on the information that is given to them. So so say you're looking at your TransUnion report on one of these sites, and TransUnion will only give them your payment history and your balances, and that's pretty much it. And they'll guess your credit score based on that, but it's not always the same as what TransUnion has, or even your FICO score, which is what banks usually look at. Credit scores are a whole different ballgame. I'm not too sure if anybody knows exactly how they're calculated, which is why those sites are always wrong. To be very general, based on my experience, under 500 is bad, might as well not be non-existent. 500 to 600 is not good. 600 to 700 is okay. 700 to 800 is good, and 800 to 900 is like, here, take all the money. And fun fact, different banks will have different minimum credit scores before they'll even consider approving you. I'm not able to say exactly, but there are sites that review different credit cards and have a pretty good guess as to what the minimum score is to get approved for that card. But even if you do meet the minimum score, that doesn't always mean you're automatically approved. So from what I've gathered from looking at so many credit reports is that it's near impossible to have bad credit if you always pay on time and keep your balances low. And it starts declining fast with late payments, revoked accounts, collections, and high utilization. Another thing that I wanted to mention at the end of this, if you're still watching, is please, whatever you do, never, ever, never, ever, 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 ever take out a payday advance at one of those quick cash now places. Number one, it shows that you're desperate on your credit report, and number two, they are almost impossible to get out from under. Interest rates on those are up to 50% sometimes, and if you were low on money one week and take out a payday advance, you're likely to not be able to afford whatever you need the next week, because that $200 turned into $300 or more if you don't pay it on time. And related to that, because I want to tell you everything I know, and this is taking a long time, but I'm getting to the end, is don't take out a cash advance on your credit card. The interest rate for cash advances is much higher than your normal interest rate, and it will forfeit any introductory 0% interest rate that you have on your card. Oh, and also, you have a separate cash limit. So say if you have a credit card that has the limit of $5,000, you're not going to have $5,000 to be able to take out in cash. You may only have $300 or $400. So that wraps it up for now. I'm going to do a second video because this is really long. Anyways, and I'm going to do a second video about common misconceptions that people have when dealing with credit cards and credit in general, and how to avoid those kinds of misconceptions or mistakes. So thanks for watching to the end. You deserve a cookie for watching to the end. So here's a virtual cookie that I don't have, but here you go. And thank you for supporting the channel by watching, subscribing, commenting, thumbs upping, all that kind of stuff. And I do have videos about my journey with the debt snowball method with Dave Ramsey, and my progress at saving up for a house. So all that stuff will be linked in the description below. And let me know if you have any questions about credit that I can try to answer. I know some things, like if it's specifically related to like the process of getting approved for a card, I might not be allowed to answer that. I have to be very careful with what I say. Even though I don't say what bank it was, I don't want to get in trouble. I'm just telling you what I know. Again, let me know if you have any questions about credit, or if you are familiar with it and have any common misconceptions that you've heard from other people that you want me to talk about, and I'll be sure to include that in the follow-up videos. So again, thanks for watching. Please subscribe if you haven't already, and I will see you in the next video. Bye.